My name's Shannon, and I have spent the last 8.5 years working at Morningstar Sustainalytics, working with institutional investors, helping them leverage ESG research to really flow capital into more sustainable, publicly traded companies. And I'm really excited to be here. Today, I've stepped into our impact solutions team more recently and really looking to bring more innovative impact signals to market. And as we've heard all throughout today, the impact investment strategies has grown into the trillions and evolved over the last decade. And impact management practices have increased in sophistication thanks to the proliferation of helpful standards, frameworks, and operating principles for IMM, some of which we heard about in the last session. These frameworks have proven to be indispensable tools for impact investment strategy, decision-making, and performance tracking. But as with any fast-growing and evolving practice, there are limitations in applications across asset classes, challenges in implementation, and what I hope you'll take away from today's discussion, a myriad of best practices and potential solutions for us to continue to raise the bar in managing and measuring impact. I have the pleasure of speaking and kind of uncovering insights from the great group of practitioners we have today, each with a unique perspective and wealth of experience in impact investing and IMM implementation. In a couple of notes of logistics, we'll start the discussion here on stage. We'll then move to a lightning round, so really have those cards ready to respond. We have some lofty statements around impact investing. Thank you. And then we'll wrap up with the Q&A from the audience. If you have any very much burning questions that are related to our discussion, really happy for interruptions as well. But if you can, we'll save questions for the end. So to get things started, I'm hoping that the panelists could provide a short introduction to yourselves and then explain kind of how impact fits within your investment process. You all work in slightly different realms of the investment universe, so just helpful to set the stage for our discussion.
Thank you. Hi, everyone. Great to be here and have spent the whole day in this room. It's been great. So I'm Amantia Mohedini. I'm a sustainable and impact investing strategist with the UBS Chief Investment Office Global Wealth Management. That requires a lot of printed paper to put down. A lot of what we do for our clients is provide the UBS house view on sustainable and impact investing, and then provide the solutions that help our private wealth clients really implement against what they ultimately define and think of as sustainable or impact investing. So kind of I'm moving here a little bit from my role to how we're thinking about impact specifically. You just heard both in my title and in how I set it up that we talk about sustainable and impact as two separate words. We think of impact investing as really the more intentional, and we'll talk about definitions later, but subset of sustainable investing. Now for us, a lot of the advice that we provide to clients really starts at asset allocation, and we believe that you can invest across asset classes with a focus on sustainability and where possible also with the focus and intent to generate impact. In practice, what that looks like is a lot of impact opportunities end up being on the private markets side of our platforms and what we offer clients. But we've seen some very, very narrow and very focused opportunities in public markets. I know that's the focus of the debate after. So I'll just say primarily we're seeing impact in those private markets, but across asset classes. And we very much focus on top-down assessments there.
Thank you.
Thank you. Good afternoon, everyone. Pleasure to be here, indeed, and with you, fellow panelists. My name is Cyril Guifas. I'm working for the European Investment Fund. And the European Investment Fund is a European Union institution and is part of the European Investment Bank group. So as such, and as a DFI, our impact investing strategy is one that is particular within the different asset classes and the different financial instruments we manage. And our largest shareholders are the European Investment Bank and the European Commission, which means that we are effectively a public investor. Certainly that has consequences on how we view our impact investing strategy. And actually, we are managing mandates on behalf of our stakeholders, and because we have a double objective to, on the one hand, ensure appropriate return to our shareholders, but also pursue EU policy objectives, we have very specifically defined impact investing mandate where we have the luxury to take significant cornerstone commitments in our equity investments. We act as a fund of fund. So to echo also what you were saying, we are very much, we view impact investing as very much a private equity / venture capital type of practice next to other instruments like microfinance. But that means we base our impact investing strategy, that is one in itself. And indeed, there were many debates around this topic throughout the day, which is largely built around theory of change. And we listen to the theory of change of the GPs we work with, and obviously this is part of the due diligence. And our investment decision is very much based on the intensity and how genuine is the GP towards his theory of change and impact strategy.
Thank you. Hi, everybody. I am John Streeter. I work at Westpath Benefits and Investments. For those who don't know, that is the pension fund for the United Methodist Church. We have about $25 billion in assets under management, and within those $25 billion, our goal is to try and align all of those investments with our sustainable economy framework, or another acronym for all of us, SEF. And we define that as economic prosperity for all, social cohesion, and environmental health. And that links well with the 17 UN SDGs. Our objective in our portfolio is to assess the true impact of all of our investments right at the initial investment and the underwriting phase. We directly and indirectly invest in impact. Our directly targeted allocations are to low carbon solutions, sustainable agribusiness, and then our affordable housing investments. That's been, we've been investing since I was born in 1990. We have been in impact investments for a long time, before it was a coined term per se. So I'm looking forward to discuss more about impact measurement and management. Thank you.
Thank you. Good afternoon, everyone. So I'm Natalia Milan. I'm the head of ESG for private equity at TKO Capital. TKO Capital is a global asset manager with 40 billion under management, investing in private equity, private debt, real estate, and liquidity strategies. And basically, we have built an impact platform that is quite interesting. We started working in it back in 2018. It was the first time when we launched an impact fund. And now we are managing more than 2 billion on impact funds and have a target of 5 billion under management on climate and biodiversity-related investments. What I can tell about it is that we started working in private equity and now it's working across the platform, so all the asset classes. But we try to put in place an ambitious impact a strategy that covers 5 main pillars. The first one is, of course, intentionality, meaning that we need to have a filter pre-investment to make sure that the companies that we are looking at are aligned with the theory of change of the fund. So that's a very important part of the process. We also have an impact committee at group level that is there to validate this fit with the impact thesis of the fund, and the investment teams who are owning this process are, let's say, quite committed to demonstrate what is the impact angle of each investment. Then we have additionality, meaning that we put a lot of efforts in addition to the capital, to the engagement that we have with the portfolio companies. We try to help the companies scale their sustainability journey, making sure that they are contributing to solutions and measuring impact, which is the third point of our framework. We started working on impact measurement back in 2019, after the first year of deployment of the fund. And we were quite poor on impact measurement. Now we have been, let's say, testing a lot of test and learn. And now we have a, let's say, robust methodology around climate change. And of course, we need to keep improving as the market improves. Fourth area, which is interesting, is that we have alignment of interest, meaning that we have allocated or have linked a portion of our carried interest to the achievement of the impact targets of the fund. This is something that we advocate for because we believe that is key for accountability for our impact funds. And finally, the newest part of our approach is all the impact audits that we put in place to make sure that we have an independent review of our impact process and on our results. In a nutshell, that's all that we do, and I will be happy to have the discussion with the panelists.
Wonderful. So as you heard, a wealth of experience on the stage today. I'll kick it to John to start our reflections on the case study we heard about and what about the case study resonated with you. How does that relate to how WestPath measures specifically impact, whether it's qualitative or more of a quantitative approach like Jem had?
Yeah, absolutely. So they mentioned the 5 stakeholders that they analyzed, which is, I wrote them down here so I don't forget any of them: customers, plants, employees, supply chain, and community. It's very similar to how we analyze our public equity portfolio with the environmental and social objectives, how we analyze our public equity portfolio. Right now, we look at a single portfolio score like they do in their case study. That portfolio score kind of shows how aligned or not aligned our strategies are with the Sustainable Economy Framework, or that SEF that I mentioned. And I think it would be very interesting, since we only look at that basically portfolio score right now, I think it'd be interesting to kind of incorporate the manager score as well, so we get a bigger picture of how, we don't just look at that portfolio score. That manager score would be a good relationship, and how to see the bigger picture for that specific investment manager.
Interesting. So looking at maybe answering that question on binary, what's more important to you, the intention of the manager or the portfolio, a little bit of both, but
exactly.
Really having that second dimension.
Yep, I think looking at both, kind of how we saw in the room, it was a 50-50 split. I think it'd be really important to look at both of those instead of just the portfolio score.
Wonderful, thanks. Any other thoughts from the case study?
Yeah, maybe I can contribute. I definitely found the framework to be very robust and advanced, and I think we can sit here and debate the merits of going qualitative or quantitative probably all day. It sounded like the GEM team landed on both, so they're starting quantitative and then going with the qualitative approach. I'll say at UBS, we are still looking at a qualitative assessment to evaluate whether managers that come on the platform meet our impact standards. We are big fans of looking at intentionality. In fact, UBS is a founding member of the advisory board of the operating principles for impact management, which we think set up a really robust way of thinking about impact measurement management, starting with those principles. We translate those into our own our own language. We're looking at intentionality. We're looking at the ability of impact measurement and management and reporting. And then we're looking at verification, and then, of course, kind of alignment around the principles as well. And so in that sense, my reaction to the case study is that it feels fairly aligned to how we see the world as well. I did find the then application of a score to the underlying portfolio to be interesting, as from a, I guess, asset allocator perspective, that's helpful. But there's a flip side of that, which is how do you, it's difficult in some ways to hold managers to your own standard. And we see this in public markets with applying, call it our own ESG scores or Sustainalytics or MSCI's or anyone else's ESG scores to a manager that maybe hasn't used that as an input to make investment decisions. And I would see a similar sort of challenge. Now, of course, the answer there, of course, is engagement. Engagement with the manager in our case, and hopefully the engagement of the manager with the underlying assets. So those are just some reflections.
Thank you.
Maybe I want to react to that. Maybe, yes, for us, of course, we are only on the asset manager views. But for us, it's very important to work on engagement. For us, this is what really brings something to the portfolio companies. We can make sure that we help the companies transition if they are in a gray case, let's say, or to scale up their impact if they are in the green case already.
Mm-hmm. And yeah, related to the case study, and trying to also share my views on how at EIF that would compare. I like very much, I think, the contribution of the case study and more globally the IMP is that it looks at the whole stakeholders' benefit, and that's something that has to remain at the center of an investment focus. Also, a question came from the audience that actually I feel very aligned with, meaning that, well, and you answered, Carol, it was like, but is avoiding harm an impact strategy? We would be of the view that it is not an impact strategy, and obviously, and that an impact investing strategy is very much about contributing to positive solution for the world's most pressing problem. And that also evokes a bit of a tension, I feel, so to say, in the impact investing community or across the impact investing community, that on the one hand you have those who advocate for, let's say, impact investing taking on the financial world and becoming the new golden standard, so to say, versus those who would perhaps think that impact investing is an investment strategy and has a degree of purity that in itself is contradicting the potentially universal aspiration of impact investing. So obviously not here to solve this question, but I find that we certainly, in our space, lean more towards impact investing in a strategy and puts the foot in the door and introduces whole new concepts such as taking into account not exclusively financial KPIs when it comes to take an investment decision or monitor the quality of an investment. So I do believe that certainly is the future of impact investing is more on that side. To give short figure, when we started investing in impact investing, we are certainly the largest private equity and VC LP in Europe. It was like 20 million in 2013. 10 years later, this year we're going to certainly end up around north of 600 million euros. So even if it remains some kind of impact strategy in itself, I mean, it's growing and growing fast and steering a whole debates across the...
All right, you're hinting at one of the lightning round statements, but I'm going to pick up on the point on stakeholder benefit really being central to your decision making, and really take a step into the theory of change. And this might be fairly more relevant to private markets, but everyone is welcome to respond here. Natalia, we'll start with you and explore how maybe there's challenges or hurdles in thinking about how you shift from outputs and reported data all the way to outcomes, and what that looks like, and maybe some things you've been working on with the portfolio companies.
Thank you, and I think that this is a very, very good question. We are all impact practitioners here, so I believe that we are all familiar with the difference between outputs and outcomes. But when we invest in our portfolio companies, we have companies that are different levels of the sustainability journey. Some of them are already embedding sustainability at the core of the business model, and these are great news. Some others have, let's say, two scenarios. One of them is that those companies, through products and services, are already delivering a positive impact, but they don't call it impact, so they don't know how to measure impact. And others that have, let's say, a huge potential for impact transition. For example, we had a company in the electric engines area. They were producing rotors and stators that are key pieces for the electric engine, for household machines, washing machine, for example. And now they are one of the leading suppliers of electric vehicles because they had this potential to become one of the leading companies in this area. So we supported this transition from an industrial company to a green player that is quite significant, because today they made more than 50% of their revenues in this area. So when we invest in, we don't have, let's say, a clear vision of the climate outcomes with the portfolio companies. They do know how to report on outputs. For example, for our companies in the energy renovation, building renovation sector, they know how many kilowatt hours they are saving through their products and services, but they are not familiar with the avoided CO2 emissions. So what we try to do with them is that we really help them in building capacity around this topic. We may support also the carbon footprinting exercise, working with our third-party advisors to make sure that we are all working together to build capacity. This is important for us to aggregate our results and communicate to our LPs, but also for them to be able to cover, say, their client demands that are growing and growing in this area.
I think that's a great example of contributing beyond capital and really building expertise and capacity within the portfolio companies themselves. So I think it's a really nice insight. Thank you. Any others that want to chime in there?
Perhaps, complementing again, sitting on the really private practice of the table, so to say. It's important to bear in mind that impact investing is not a reporting standard. Yeah. So that means moving from output to outcome requires, at least that's the way we view it, requires to give a great deal of freedom to the GP or a great deal of freedom to the manager of the investment, because they're the one who knows best their investments and their portfolio companies. Again, as a fund of fund, that's what we're confronted with. So let's be honest, it makes it a nightmare to consolidate. That's for sure, because that means basically you can very much end up with one set of indicators per portfolio company. So that's difficult to compute in absolute terms, but that gives, that has the immense benefit of being very close of what the data you have as an investor is very close to what effectively happens at the level of the portfolio company. So as trivial as it seems, the biggest threat I believe for impact investing is that you end up with data and an impact KPIs altogether that look interesting, that perhaps carries interesting information, but whose attributability to the portfolio company is questionable. And if this question is asked, then already we are all at risk of being part of an impact washing project that obviously all of us, no matter where we sit on the table, want to avoid. So again, I would say on this output versus outcome, we have some companies that work in the education space, in the access to employment space, who sometimes use one output indicator next to an outcome indicator, next to perhaps a more qualitative one around the satisfaction of the users, of the product, of the service. And this composite index, compounded index, gives a fair impact reflection of what the company enables. Again, difficult to report on and to consolidate, but true and attributable.
Yeah.
And just to jump in on this, if I ask myself the question, why is it we're even having this question, right? Why are we discussing outputs and outcomes? Is ultimately it's a capital allocation question. That's also why we're splitting hairs sometimes on the definition between impact and sustainable and responsible and this and that. We need to know whether we're allocating capital to meet all of our objectives. I think while completely agree that the problem of data is one that could get and has already gotten out of hand with outputs and outcomes, in some ways, that's my problem for our clients. That's your problem for your shareholders. That's your problem for your LPs. But it's our problem as impact practitioners. It's still having a clear view on what outcomes are is important to then know what to manage towards, at least. So it's a form of accountability, and then we know at least what's the goal and how far we are going from the goal. Now, that said, on the flip side of this, I recognize that a clear challenge is if in impact investing we're looking for those companies with lockstep impact and financial return potential. For some companies, managing to the avoided emissions may not be actually the signal that they need to know if their business is going well. Maybe all they need to know as entrepreneurs is how many heat pumps they are installing, because then they know how they're growing, and so that is not, I'm surfacing that as a question, I guess. I don't have an answer myself. I do wonder if when we move to outcomes, how helpful that is for the actual companies that need to also manage the performance.
I maybe have a quick reaction on that. So yeah, what we really care about when we engage with our portfolio companies is about how they manage the outputs, and then the outcome part of it is more to, let's say, build capacity, but it's not what we really ask them to do day to day, because it's quite theoretical. And I believe that it's better to be pragmatic and keep with a set of KPIs that are relevant for the business activity and that are material in terms of the double materiality approach, both for the financial part of the business, but also in terms of what are the significant impacts of the company. If we are able to work around that, for me, I think that we have a nice impact approach. If they are, in addition, are able to manage outcomes, that would be great, but it's not my #1 priority today.
Wonderful, thank you. Thanks for those insights. And I think also, Ciro, you brought up a good point on just also keeping those two separate and distinct and not conflating the two is also really important, to not make assumptions on outputs are outcomes, but that makes for complicated reporting. So I understand the challenge there. Before we go to lightning round, I just want to ask one more question and maybe more of a hopeful, optimistic view from you all on the potential, the thing that you see as the greatest potential for being able to scale impact with integrity. So whether that's data standardization, whether it's disseminating expertise on impact, really, where do you see that kind of North Star and where we're going?
Yeah, I can start it off. I think the biggest opportunity would be to create some sort of standard for data. When we created our impact measurement management tool to see how our equity portfolio is aligned with the SDF framework or the SDGs, we wanted to look at our respective benchmarks. And that data that we looked at a bunch of third-party vendors to see which data really is the best, but each vendor kind of had their own little twist to the methodology. So it was really hard to choose which data to go with. So I think some sort of standard of data would be huge to kind of help scale impact as a whole and be able to measure and manage it as well.
Jump to anyone else who wants to have quick thoughts here.
I'd agree. Standardization is a big challenge on the data on the one hand, on what does this thing even mean? What are we all managing towards? That's, again, where we think the impact principles can be one very helpful way of thinking about it. The IMP, different level downstream, but it's another sort of helpful kind of tool or framework. So more of the industry coalescing would be helpful. I think ultimately, in some ways, one challenge, and this is what we're seeing on the ESG side or public investment side of the table, is a challenge about collectively the industry maybe not being clear about what to expect, sort of what's the goal, and then going towards the goal. We saw ESG become everything to all people, and now it's like the thing that everyone and all people kind of get to criticize. And for the impact industry specifically, it would be important to just be clear what are we trying to achieve, and then stick to that as opposed to kind of mission creep as well. So,
yeah, that alignment of expectations is really important. Thank you.
I would say that alignment of interest for us is key. So making sure that if we are combining attractive, competitive financial returns with impact, we put this impact as well in the impact KPIs that are going to be attached to the remuneration of the manager, but also of the portfolio companies.
Mm-hmm.
Yeah, I would very much agree with what you said, Natalia. I think that since impact investing is not a reporting standard, it cannot afford to only be collecting data for the sake of collecting data. I think we all know what happens to reports we receive on a quarterly basis, and we perhaps have a higher ambition for those data that are actually also hard and long to extract and involve a lot of work. So I would definitely concur to the fact that impact achievement has to be part of the alignment of interest, the way we view it, and you alluded to that, and that's also the way we operate since 2012, is that when we invest in an impact fund, the carried interest or the financial incentive of the manager has to be subject to not exclusively financial performance, but also impact performance. Otherwise, basically, what you've been presented and looking at due diligencing the investors' deck basically is not delivered at the end of the day. So that's a very important element, and perhaps even the most significant breakthrough of impact investing in the financial space, beyond what we're discussing, that it precisely seeks to incorporate in the investment decision the impact that is generated out of an investment. And so there are a number of initiatives around trying to monetize impact, and so perhaps the next step, or looking back, fast forward 100 years, we look back at that period now as when impact investing actually started including in reporting standards in the creation of accounting norms, incorporating positive impact on society and environment. Let's hope for it.
And hopefully in 100 years we've been successful and there's still a planet
That's a good one.
Impact investing.
That's a good one, indeed.
Wonderful.
Maybe I would like to add something on this point. I think that ownership is key as well. I really believe that investment teams should own the impact strategy. Myself, I'm sitting with the investment teams, and I'm part of the investment team, but they are really the number one filter for impact investing is not me, it's the investment team, and for me this is what we need to do in order to make impact advance.
And do you think that manager incentives play into that as well? I know that came up in the previous session on really aligning manager intent and making sure that that's credible in there, that incentives would be beneficial in that?
Sure.
Yeah. It's kind of leading the witness there, sorry. Okay, so we have just over 10 minutes left. We're going to do a lightning round, so everyone wake up. Get ready for your contribution here. We don't have it up on the slide, so you're going to have to really practice active listening. The first statement, and you all can grab one of each. Red / I think that's red, will be disagree.
Thank you.
And green will be agree. So the first one is, ready? Attribution in impact reporting should factor in shares of an investee held. I'll repeat it again. Attribution in impact reporting should factor in shares of an investee held. Oh. Okay, so majority agree. Any disagrees? No disagrees?
No disagree, but in reality it's more difficult than that because impact measurement is complex already. So if you need to attribute it to shares, it's difficult. But yeah.
Yeah.
As an idea, yes, I agree.
And different in public markets as well than in private markets.
Absolutely, and especially if you're thinking about that individual investor that might be sourcing information from a platform, understanding how their individual investment made and attributed to positive impact. So it's a bit of a head scratcher there. Thank you all for contributing. So the next one, I'm going to repeat it. Monetizing impact is the quickest route to large-scale impact integration. So the act of monetizing impact being the quickest way for us to scale impact integration. Can I call on because I'm seeing some reds, can I call on an audience member that disagreed? I'd love to hear reasoning here. It's a nuanced one. I purposefully did really loaded statements. They're not black and white. But any brave audience members that held up a red? You're not wrong. I think I agree with you.
We have a consensus, apparently.
Yes.
No? No takers? Yeah. Thank you.
Just for the fun of getting our conversation going.
Yeah.
I want to know how big you want to go with your monetization.
So, okay, great. So that can be, I can clarify, impact-weighted accounting and literally putting
That's what I was hoping.
Impact into dollars.
So how about if we ask it this way? haven't we seen scale from carbon credits? Have we got social credits, and could we get some? Because if we could, then I would answer yes. But if you mean the small-scale version, that I don't agree with. So impact-weighted accounts, how many people in the room know about those? And that was a question I had. Are we going to pay attention to those?
It's definitely in development, and research is coming out. So I'd encourage you all to pay attention to that. Coming out of Harvard, and now I think sitting under IFVI, someone correct me on the acronym, but something to look into, homework to take away from today. Harvard Business School, but it went under a different organization. They kind of pushed it out of Harvard's. GSG is the steering committee for it, and then I think it's IVFI.
That says something around.
Good.
Yeah.
Right? It's evolving, everyone, so keep an eye out for it.
Too many.
All right, let's move on to our next lofty impact statement. Investor-led contribution is required to be defined as an impact investment. So I'm gonna, because I'm not putting it up on the thing, compared to only company contribution. So we looked at contribution with the dimensions of impact. There could be investor contribution, and there could be company contribution, or asset level contribution. Investor-led contribution is required for it to be defined as an impact investment. John, do you want to take this one?
Yeah, I think you need both the investor level and company level contribution. By building the IMM tool, we wanted basically, so going back to the conversation of outcomes, our outcome with building this tool, we wanted to engage conversations with those asset managers who aren't as aligned with our SCF or sustainable economy framework. So we're hoping that conversation will lead to the company level contribution as well. So that's kind of, I think you need both.
I appreciate the both, and I think the language that we use is around impact investing as being about investor impact. And you also have impactful companies, and every activity we do has an impact on the world. But the question is, why did you give me the money, or where did I give the money back to? So that's the distinction, but it's a both end. Yeah.
Absolutely.
I'd also want to mention that when we invest in an impact fund, that most often in our spaces would be a venture capital fund, we also are particularly cautious around making sure we invest in GPs who invest in companies whose business model is in itself solving at scale a social or climate issue, which means that as much as to make sure you are a very strong backbone around impact across the value chain, it is also fair to assume that no matter where the money comes from, if the business model is set up in such a way that it is strong and in itself solving a climate or social issue, well, no matter who's investors, I mean, the business model will in itself scale and solve issues.
Mm-hmm. Okay, yeah, and to the previous session's point, maybe that's one you just keep a really close eye on, that you ensure that just because there's no intention there, there's a need for additional monitoring of the end company. Okay, so we have one more. This came out of BNP Paribas ESG Global Survey from 2023. So interested if you all agree. Impact investing is set to overtake ESG integration as the most popular strategy for investors to achieve sustainability. You want me to read it again? Impact investing is set to overtake ESG integration as the most popular strategy for investors to achieve sustainability. I'm not seeing everyone raise let's raise it with a bit more confidence here. You are all impact professionals. I trust you have an opinion. All right, okay. I'll call on the disagrees first. Do you want to start us off?
I think ultimately it's a question of how those who read the survey interpreted the word impact. because while ESG integration is probably becoming table stakes, and we're likely to see more thematic investing or sustainability-focused investing, if we say most impact is most likely to be in private markets or in areas where investors can have a lot of active contribution, then by definition you look at an asset allocation and it will be like 80-20 at best, public markets versus private markets. So I'm perhaps being provocative there and just sticking to my own definition of impact here at UBS and saying it's unlikely to overtake. Now the flip side, this side is perhaps here in the US market in particular, with a lot of the debates around ESG, some of the backlash and so forth, maybe the families that are allocating and the institutions that are allocating will be more comfortable with clear impact than the murkier stuff. So that's the flip side.
Wonderful. Anyone from the audience want to chime in on why they had to agree, disagree? All right. That was it for the lightning round. Thank you, everyone, for participating. We have a few more minutes if anyone from the audience has any questions for our panelists today. So quiet group, yeah. There's one in the back.
Hi, just a quick question. Do any of the panelists have an impact strategy as it pertains to emerging and frontier markets?
Impact strategy as it pertains to frontier or impact emerging markets.
Apologies if I don't answer straight your question, but as far as we are concerned, again, we are focused on the European Union. That's our mandate. And that's actually also, on a personal note, my background is in microfinance, microcredit. I learned it in more emerging markets and also actually studied on how to implement or import this tool in the EU and in more developed economies, so to say. And I strongly believe the intensity of the problems should not make us blind on how much there are social issues, in the suburbs of Sofia that are important, or London, or that are perhaps not as, again, intensity we can debate, but that's actually one of the consequences, I believe, of the globalization altogether, is that between countries, differences have reduced over time in the past 50 years, certainly fair to assume, but within the countries, inequalities have increased pretty dramatically. So again, my view, that should be impact investing has a role to play in New York as much as in Kampala.
Any other thoughts on maybe where you have exposure for impact? You can jump to another question in the audience. I think we have time for one more. Yeah.
This question's for you, actually, Shannon.
Oh boy, I was not prepared for that. I'm a moderator. I'm not answering any questions. Very short.
We talked a lot about output and outcome.
Yep, of course.
And I dug into all the metrics related to SDG 5, gender equality. So if you have a binary, do you have a woman on the board? Yes, no, or in the C-suite? That is an output,
Exactly.
But the outcome, does that woman have a voice at the table? Exactly. How do you measure that?
Oh boy. I think that is one where there's a bit of nuance in traveling from output to outcome. That one I view as having a closer connection between that output and outcome, and providing opportunity to allow for more diverse voices. And I think that in terms of how investors make decisions, that would be a leading output to move towards. But I think that's really at the discretion of the client or investor clients to determine, how we take this data and move it into outcomes. That could be dependent on the company itself and what that changes in terms of decision-making, performance overall, and how that's maybe reflected throughout the company in terms of gender diversity as well. So A bit of a non-answer for you, but just that's really, for Sustainalytics, that's our job, to provide more of the output side of things for our clients to translate as they have it in relation to their own investment strategies.
Part of audit committees or you're part of compensation committees, it's very easy, or you sit on the ESG committees, it's quite evident that you have a voice because you're able to guide strategy and take action on certain things. And again, many resolutions you would be involved with. Who's put forth the resolution? So I think there is data that you can capture around women and their involvement at board level. And I think by C-suite, I mean, again, if you are a CEO of the company, if you are the chief strategy officer of the company, if you are the CFO or the COO, how can you not have a voice?
Exactly. No, and I think that's a really nice finish off to that topic. I think there is such a strong connection there between output and outcome. Any other questions for our panelists? No? Well, thank you so much for sharing your insights. I'm sure they're all